In this video, I want to go over some income statement concepts. So first you'll see that the income statement, which we went over, is a period of time statement. And this is very important. What we mean by that is that the income statement measures activity over a period of time. So the income statement will always have month ended, or quarter ended, or year ended, or some time period ended. It could be day ended. So when you look at the income statement, think of it as it tracks activity over a period of time. It could be a day, a week, a year, a month, etc., right? So the income statement is a period of time statement. The other thing that's important is that income statement does not tell you how much cash a company received. And this is key because a lot of people, when they look at this, they say, oh, this company had $890,000 in revenue. That means this company had $890,000 in cash. That is not true, right? And we'll learn more about that later when we deal with the accrual concept. But really, what we're talking about here is when we say revenue, what does revenue mean? Revenue means the value of goods and services provided to customers. So if I sell you something that is $500, that doesn't mean I received $500 in cash. That means I gave you something and the value of that was $500, right? And what are expenses? Expenses are the cost of goods and services provided to customers. So the expenses that I incur is how much it cost me to provide those goods and services. So salary expense is my cost for salaries, and utilities expense are my cost for utilities. So let's illustrate this by looking at two scenarios. Look at scenario one, right? So let's say I sell something and I sell something for $1,000. I'll have revenues of 1,000, I'll have expenses of 400, and my net income will be 600, right? That makes sense to a lot of people. So if I sell you something and you pay me in cash, so this is a cash sale, okay? I sell you something and you pay me in cash. I'm gonna have revenues of 1,000, expenses of 400, and net income of 600. So 1,000 minus 400 is 600. But let's look at a credit sale. I'm gonna sell you the exact same thing. Let's say it's a vacuum, whatever it is, right? And you do not pay me. So let's say I sell it to you and you say, hey, I don't have any money to pay you today. I'm gonna pay you next week. Well, guess what? According to the accounting rules, since the sale was complete, meaning that I gave you the product or I provided you the services, I'm also gonna have revenues of 1,000. My expenses are also going to be 400, and my net income is also going to be 600. So look at scenario one. In scenario one, I've actually got $1,000 of cash in the bank. In scenario two, I have nothing in the bank. But my income statement for scenario one and scenario two looks exactly the same. In scenario one, where I received cash, I've got $1,000 in revenue and $600 in net income. In scenario two, where I did not receive any cash, I've got $1,000 in revenue and $600 in net income. So as I said, the income statement does not tell you how much cash a company received. The income statement just tells you the value of the goods and services provided to customers and the cost of those goods and services provided to customers, and you want the revenues to be higher than the expenses to determine profit. Also, right, these things here, how do we calculate net sales? I'll let you look at these formulas, right? Net sales is sales minus sales discounts minus sales returns and allowances. Gross profit is net sales minus cost of goods sold. Total operating expenses is selling expenses plus administrative expenses. And then operating income is gross profit minus the total operating expenses, right? I'm going to put in here total operating expenses. And then total other revenues and expenses are interest revenue plus interest expense plus gains plus losses. Remember, interest expense is always negative and losses are always negative. So when you're adding these two, it's adding a positive with a negative. And then income before income tax expense is operating income plus total other revenues and expenses. And then net income is income before tax minus, so income before income tax expense, right, minus income taxes. So that's what we want, minus income taxes. Income tax expense, and that is net income. All right, so that's some concepts for the income statement. The key is, and then one of the key concepts is that a period of time statement, and that the income statement doesn't tell you anything about the cash of a company. The cash flow statement will tell you about that, and we're going to learn about that a little bit later.